Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look outside the S&P 500 at other indexes in other sectors to see if they're having any kind of an impact on the S&P 500. We also look in other markets that are way outside of the stock market just to see if we can get any clues as to what might be happening in the market. This is being prepared for Monday, August 14th. First thing, before I start, I am going to do a free online course in September. I haven't set the actual dates yet. Probably what will happen, these will be 1-hour sessions during the times when the market is open, probably about lunchtime, East Coast time. I'll also be hitting at kind of a high level some different strategies that you can implement. I won't get too deep with those, and I'll also be talking about support and resistance. The idea is, instead of having one longer class, we're going to break it up into 3 1-hour sections. This will be recorded on Zoom. It's completely free. There's no obligation. If you have any feedback or input, please feel free to send me an email. I provide an email at the end of this video, or go ahead and post a comment on either YouTube or Rumble. When we look at intermarket analysis, the first area that we like to look at is S&P 500 valuation. Are we considered expensive, just about right, or cheap on a historical basis and somewhat on a relative basis? The first area that we look at is by looking backwards at the PE ratios and look at the trailing 12 months historically, what have earnings been and what were the valuations at that time. We have a PE ratio of 20 or above, that's considered to be expensive. Between 11 and 19, that's fairly priced. 10 or below, that's considered to be inexpensive or cheap. Right now, even though we've been declining lately with the S&P 500, we're still well above this red dashed line, which is a PE ratio of 20. On the bottom, I have the spread between the two showing that when we're above 0, we're considered to be expensive on a historical basis. Here's another chart just going all the way back to 1980 and different events that have happened and what the valuations were on a historical basis at that time. We also look at another ratio called the Shiller PE ratio developed by Robert Shiller. This takes more of an average over a period of time. The score that we're getting right now is 30.79. The median and the mean is between 16 and 17. So on a historical basis, we are considered to be overvalued. Looking at historical values, we are considered to be expensive. But the market doesn't do that. They look forward. Right now, the forward-looking S&P 500 PE ratio is coming in at 19. We're under that 20 mark, but we're above 15. When we look at the mid-caps, we're under 15 and we're coming in at 14. And with the small caps, we're even under 14 at 13.8. So we're more fairly valued with the small caps and the mid-caps. Then to plot them all together, we have the S&P 500 in red. Then we have the mid caps and the small caps plotted in blue and in green just to get an idea of where we're at together. Then we also look at the Russell 2000 small cap index. There's another index called the S&P 600 small cap index that we also look at, and there are different PE ratios for those looking forward. Where for the Russell 2000 we're at 23, where at the small cap index we're at 14. Another area that we look at is growth versus value. Growth is when you want to buy low and sell high. Value is what folks like to get into when we're having difficulties in the market, and then we can compare the two with each other. The first thing we look at is a peer growth index, and it has been showing some improvement, and we're getting close to seeing a golden cross here where the 50-period moving average moves above the 200-period moving average. But it hasn't quite done that yet. Also, value has been showing a little bit of improvement, but we're not quite there for a golden cross. What's interesting is when we do a ratio between the two. On the top, we have growth versus value, showing that growth is outperforming. And then on the bottom, we have value versus growth, showing how value is underperforming. The reason why I do multiple charts and sometimes inverse charts, because they calculate slightly different, and we want to see the same thing at the same time. When we look at the growth ETF versus a value ETF, it's showing the growth is outperforming, where we saw a recent golden cross with this ratio. The inverse of that is showing how value is underperforming, where we saw a recent death cross. We look at a peer growth index versus the peer value index, where we're chopping around, but we're still seeing that growth is outperforming value. Then when we look at value compared to growth, it's showing how value is underperforming. And then the last chart looks at another index showing how growth is outperforming value. Then we look at the small cap growth versus small cap value. Lately, it's been going down. You could almost suggest it's in a downtrend. At best, it's been going sideways, but longer term, it still is going in an uptrend. When we look at mid-cap growth versus mid-cap value, we saw a lot of strength earlier in the year, but now it's starting to fall back a bit. We're still in an uptrend, but we're worried about this sideways action that we've been seeing. We look at a growth index versus a value index, showing how growth is outperforming but seeing some recent weakness, and how value has been underperforming but showing some recent strength. Then the most important one for the S&P 500 is the growth to value ratio. In the short term, we have been declining, but longer term, we're still in an uptrend, showing that growth is outperforming value. Some different inflation gauges. This is a monthly chart of the CRB index on top, where we've been seeing some improvement in that index. It's crossing above its 12-period moving average. But then we look at inflation to deflation and take a ratio of that, and that is starting to decline, suggesting that inflation is subsiding right now. We also look at the CRB index by itself. It has been in a downtrend, but lately we've been seeing some strength in the CRB index, and we could be getting close to a golden cross here. We look at the Baltic Dry Index. What does it cost to ship products from one place to another? We're still in a downtrend with this, suggesting that the cost is not going up substantially. Some other markets that we look at. Aluminum, that's in a downtrend. We look at corn, which is in a downtrend. Wheat is also in a downtrend. Fertilizer has been ticking back up, but still in a longer-term downtrend. Oil has been bouncing back up. We're not quite at a golden cross here yet, but we're getting above 83 for the price of oil. Then when we look at gas, it's also been coming up, and we did see a recent golden cross. Natural gas, still in an overall downtrend, even though it has bounced back up after taking a big fall. Heating oil is also in a downtrend, even though it's been bouncing back up lately. And then we look at diesel. It's also been coming back up, but still in a longer-term downtrend. Copper, which is in a slight uptrend, it's really been chopping around. It's been going back and forth between Death Cross and Golden Cross. Right now, it's just going more or less sideways. We have seen some recent weakness over the last few days. One thing that the copper market is used for is to look ahead into the economy. When it's going up, they're thinking the economy is going to be fine. When it's going down, they think the inverse of that. And since we're getting a lot of conflicting information about the economy, it's really been chopping around. We look at the copper to gold ratio. When the economy is doing better, copper outperforms gold. When the economy has some difficulties, gold outperforms copper. For a lot of 2023, copper has been underperforming gold. Then it saw a breakout compared to gold, and now it's starting to see some more weakness. Here's a longer term look at that same chart, where we also plot the 2-year yield as well as the 10-year yield. And typically, these don't get all that far apart from each other, even though they're on different scales, and they tend to go in the same direction. Where we see yields going in the same direction, we see the copper to gold ratio going in the opposite direction. So this is suggesting kind of a confused market, but this is what we've seen for quite a while now. Gold continues to be in an uptrend, even though we're seeing some recent weakness. Silver also in an uptrend, but falling below the 200-day moving average. We look at gold on the top and silver on the bottom, and then on the bottom we take the gold to silver correlation, and not surprisingly, they have a real strong correlated relationship, meaning that they tend to go in the same direction at the same time. We also look at the gold to silver ratio on top, and then we look at the US dollar index down below. Looking at the very bottom, we can see that the relationship between these two is fairly strong. Some general observations. When the US dollar index goes up, gold outperforms silver. When the US dollar index is going down, silver outperforms gold. Both can be going in an up or a downtrend. We're just looking at what tends to outperform over the other during the course of time. The dollar index, after dropping below 100, has been seeing a nice little bounce. We're getting up above 102. When we compare the dollar to the euro's in a solid uptrend compared to the dollar, but we're seeing some recent weakness in the euro as the dollar's been bouncing back. We also compare that to the Japanese yen, which is in a downtrend compared to the dollar. Here's the Japanese yen to the dollar, showing that we are in an overall downtrend. And right in about the middle of June, we saw a death cross with this ratio. But the British pound is still holding up quite well compared to the US dollar. Even though it's falling back a bit, it only came down to its 50-period moving average. Some different index ratios. First, we look at the S&P 500, which is a weighted index, meaning that the big companies account for more movement in the index itself. And then we have an equal weight index where all the companies in the S&P are all treated the same. They're performing about the same right now. We've been seeing some weakness as of late. Then we look at the S&P 500 to the CRB index and take a ratio of that, showing how the S&P has been outperforming, but we are seeing some recent weakness. We look at the inverse of that, showing how the CRB has been underperforming, but showing some recent strength. Then we look at the NASDAQ 100 and compare it to the S&P 500. Up until about 2 weeks ago, both have been doing quite well, but the NASDAQ 100 continues to outperform, even though this ratio is falling back slightly. We look at the S&P 100 and compare it to the S&P 500. We did see a death cross here, but the S&P 100 has been holding up fairly well, and we're almost ready to see a golden cross with this ratio. The small caps to S&P 500, they continue to underperform. The NASDAQ to S&P 500, both have been doing quite well, but lately the NASDAQ has been underperforming the S&P, but still in the longer term, the NASDAQ is outperforming the S&P. The NASDAQ 100, which has been doing well, and the NASDAQ, which has been doing well, also shows that the NASDAQ 100 is still outperforming the NASDAQ. We look at the mega cap growth, the really big companies, and compare it to the equal weight S&P 500 index, showing that the mega cap stocks continue to outperform even though we're seeing some recent weakness. We look at the S&P against some other stocks. First, we look at an advanced decline line study where we're looking positive across the board with the NYSE, the S&P 500, the mid caps, and the small caps. We have seen some recent weakness here, but we're above all of the moving averages. We look at the biggest software companies in the US. Even though they're falling back, they came down to their 200-day moving average. Will they find support at this level? But overall, they continue to be in an uptrend. The mega cap growth also pulling back down to its 50-period moving average, but still in an uptrend. The robotics and AI ETF has been seeing some weakness lately, and it's really underperforming when we compare it to the tech sector and take a ratio. The S&P 500 to shorter-term bonds show that the S&P has been outperforming, but seeing some recent weakness. We look at a broad market ETF and compare it with further out bonds. Also, overall uptrend when we look at stocks versus bonds, but some recent weakness. We look at the tech sector and compare it with bonds. Also an uptrend, but recent weakness. We look at the Dow Jones Composite Average, which is the Dow, transports, and utilities together. It finally looked like they were starting to break out here. We did break out, but now we're falling back slightly. However, the Composite Average continues to be in an uptrend. We look at low volatility stocks, which hung in there a lot better in 2022. They've been chopping sideways a lot in 2023, but they're still in an uptrend. The low volatility stocks compared to the S&P 500 shows that the low volatility stocks are really underperforming. We also take a look at traditional Dow theory, where we're seeing a breakout of the Dow, also the transports, which have been breaking out but seeing some recent weakness, and then I add utilities to the mix, where they have been really underperforming as of late. We look at a ratio between the transports and the S&P 500. When this is going up, that means the transports are outperforming, and that could be healthy for the market. Typically, when the transports are doing well, that's good for the economy. We also look at the Dow against the transports and take a ratio. When this is going down, that means the transports are outperforming the Dow. Just to get an idea, we have the S&P 500 and the transports, and we have a correlation about their relationship. When this is very high, like it is right now, it means they're going in the same direction and they have a strong correlated relationship. Then we have a new take on Dow theory, where instead of using the Dow, we use the S&P. Instead of using the transports or railroad stocks, we use the NASDAQ. We broke out quite a while ago, and we've been looking healthy, although we have been seeing some recent weakness going back to the latter part of July into the early part of August. The FANG index, this is a little bit of a concern. We're starting to drop below the 50-period moving average. Before Friday's session, this is what I was watching to see if we could get that back. Nope, we weren't able to do that. We also just set a recent all-time high with the FANG index where we broke above the 2022 high. Then we've been coming down and we've been showing some weakness since that time. ARC also seeing some weakness after giving us a recent golden cross. We look at the S&P 500 and then compare it on a monthly chart with stocks in Europe, Australia, Asia, and the Far East. We're above this moving average. That's suggesting that the S&P is outperforming. We're also coming up to this zero line here with the PPO. That's also positive longer term, showing that the S&P is outperforming global stocks. The NYSE composite is also in an uptrend. All stocks, even though we saw some recent weakness down to its 50-day moving average, it's still in an uptrend. Emerging markets also still in an uptrend, but doing a lot of chopping sideways. We look internationally. China's starting to roll over. Emerging markets are rolling over. Europe is rolling over. Japan and the US are also showing some weakness at this time. We look at bonds versus stocks. Here's the total bond ETF, chopping sideways, but still continues to be in an uptrend. The Pring World Bond Index really chopping around all over the place. It's kind of hard to tell whether we're going through a golden cross or a death cross here. We're just kind of keeping an eye on this support level to see if it holds. Are we going to break to the downside, or will we get some support and be able to go back up? When we look at stock to bonds on a monthly chart and take a ratio, it shows that stocks continue to outperform bonds. When we look at riskier bonds and compare them with more conservative bonds, when this ratio is going up, that means folks prefer more risky bonds because they get a higher yield from that, even though they have to assume more risk. Then we look at some correlations. We take the stock to bond correlation, where stocks and bonds are having a pretty strong tendency to go in the same direction. We look at the high yield corporate bond ETF. This means junk bonds, where they continue to be in an uptrend. Then we look at investment grade bonds, more conservative. They've been chopping sideways, but they continue to be in an uptrend. But when you compare stocks to bonds, bonds are underperforming stocks. The Dow Jones Corporate Bond Index has been doing a lot of sideways action in 2023, but they're still in an uptrend. Then we look at the price of the 7 to 10 year bond ETF. We're seeing some weakness here. The RSI is dropping below 50. We've seen a recent death cross based on price. The MACD is also negative, and we've seen some real weak price action lately. Now, the other charts after this will just be showing the yield or the interest rate. Here's the 10-year yield, where we're coming back up and possibly testing this previous high. We're also seeing 10-year yields start to go up. And Chris Shavako from Shavako Capital, he pointed this out. If you go all the way back over 40 years and we see bond yields making a series of lower highs and lower lows as interest rates have been coming down, down, down. After we finally hit bottom in 2020 and we're starting to come back up, is there a new world coming in as far as yields are concerned and interest rates? Are we going to be in an environment going forward where we do see higher interest rates? We're just watching to see this play out. When we look at the S&P and compare it to the 10-year yield, we're going sideways an awful lot, but the S&P is still outperforming even though we've seen some recent weakness. The 30-year yield is still above this 61.8% retracement level, still has a long way to go to get back to this previous high. Junk bonds continue to be in an uptrend, and when we compare junk bonds with government bonds, junk bonds are outperforming government bonds, which is pretty much the way it should be because folks have to assume more risk. Looking at a daily chart of the yields, where we did see these yields really going up in the latter part of the week. Looking at a weekly chart internationally, the UK has the highest rates, followed by the US and Germany. Japanese rates are still pretty low. They're doing some things over in Japan to try to make things better, and we're waiting on the sidelines to see if that's going to work. If that doesn't work, that could really feed over into the US bond market and really start to push interest rates higher. Then we look at a 5-year yield and we do a study on that. This is a daily chart where we're above the moving average, showing that the 5-year yield is in an uptrend. But longer term with the special K, it's showing that we're in a downtrend. And when we look at the KST, it shows that we pretty much have been going sideways. Then we look at another study of the 5-year yield on a weekly chart, showing that we're above the moving average. Short term, we're starting to go negative. Intermediate term, we're positive. And long term, we are seeing things more negative. Then we look at the long bond based on price, showing that it is in a downtrend. Short term, we're in a downtrend. Intermediate term, downtrend. Long term, we're still in an uptrend when measured by the KST. We look at the MOVE index, which measures the volatility of bonds. Below that is the VIX, which measures the volatility of stocks. And then at the bottom, we have a correlation between the two where they're having a slight tendency not to really go in any kind of a direction with each other right now. We look at the price of the 30-year bond and then compare it to the CRB index, showing that bonds continue to outperform the CRB index. Then we look at the S&P 500 against some other sectors. The materials are in a downtrend when compared to the S&P. Communication is in an uptrend and been a stronger area in 2023. The energy sector seeing a recent resurgence, but still in a downtrend compared to the S&P. The industrials also bouncing back up slightly, but still in a downtrend. The financials bouncing back up a little bit, but still in a downtrend. The tech sector seeing some weakness, but still in an uptrend. Real estate continues to be in an overall downtrend compared to the S&P. The staples, a little bit of a bounce, but still in a downtrend. And utilities, a little bit of a bounce, but still in a downtrend. Then we look at the S&P to utilities ratio. And when this is going up, this is one of our possible positive scenarios. And this often gives good support to the S&P. It's been hanging in there fairly well, Not so much lately because of the strength in the S&P, but more because of weakness that we're seeing in utilities. Also, when we top out and start to come down, that will mark some kind of a top in the S&P 500. We look at healthcare to the S&P, also a little bounce lately, but still in a downtrend. Here's another look at healthcare, showing that it is in an overall downtrend, but over the last week saw some strength. We look at discretionary to the S&P. After spending a long time in 2022 underperforming, now it's been one of the stronger sectors in 2023. The staple sector pretty much going sideways, but still in an uptrend. The tech sector also seeing some recent weakness, but still in an uptrend. The SPX index, which are semiconductors, recent weakness, but still in an uptrend. The tech sector to the S&P really saw some weakness, but still is outperforming the S&P. The energy sector, which is bouncing back compared to tech, has still been underperforming overall. When we look at growth stocks and compare them to government bonds, growth stocks are continuing to outperform bonds. The tech sector to the rise in interest rates show that the tech sector is outperforming. Then we look at an inverse of that same chart where the 10-year yield has been underperforming the rise in the tech sector. In some ways, discretionary is more growth-oriented, where you buy low and sell high. In 2022, staples outperformed. In 2023, discretionary is outperforming, and we're seeing that even though discretionary's had some weakness in this ratio, it's still in an uptrend. Then we look at an inverse of that, showing how the staples have been underperforming discretionary. Looking at gold, gold's still in an uptrend, but it's really underperforming the S&P 500, and in this ratio, we're seeing a recent death cross. It's also having a difficult time when compared to the US dollar. It's coming back up to resistance and having a really hard time breaking out. High leverage loans. These are risky loans. They continue to do quite well. And as I always say, if the economy was getting ready to fall apart, this would probably not be in an uptrend as it is right now. Then we look at another ratio, small caps to the S&P, that's the red line, where they continue to underperform. In a good solid environment, we want to see this red line going up, matching the blue line, which is the S&P 500, and we haven't seen that for quite a while. Bitcoin, and I had to change over to a new index here. It's still in an overall uptrend. It got up into the 30-31 range, but then we're seeing some weakness as it drops back below 30,000. We're also keeping an eye on the home builders ETF, where we're seeing some weakness in the S&P, also some weakness in the home builders ETF. The ratio's been going down. This is what we want to keep an eye on. When this relationship or correlation starts to come down to this area, we're looking for some kind of negative divergence. Are the home builders outperforming the S&P, or is the S&P outperforming the home builders? We won't know that unless we actually drop down to this level. This is a chart that I look at every day, and if something is happening, I bring it up in the daily video. We look at InterMarket Analysis. Going back to the beginning of 2023, stocks are still doing the best, followed by oil, which has really been seeing a comeback, then gold, then the dollar, and then bonds are now negative going back to the beginning of the year. Some correlations we keep an eye on. We look at the S&P 500 compared to the dollar. They're having a tendency to go in opposite directions. Then we look at the S&P 500 to oil, also going in opposite directions. The S&P to the 10-year yield also slightly going in opposite directions. The tech sector to the 10-year yield, they're pretty much neutral. When we're at minus 0.25 to plus 0.25, I consider that to be neutral. We look at the S&P 500 to the 2-year yield, where they had been going in the same direction. We're seeing that relationship weaken slightly. Then we look at some long-term secular, that means really, really long-term, that can last decades. And then cyclical, which typically lasts years. We look at some trend studies. This is the NYSE Composite Index on a monthly chart, where we're continuing to be above a long-term moving average. When we look at the bottom, the Kopic curve, which is a momentum oscillator, it's going higher and actually starting to cross above this dashed line. So in the background, this is looking more positive. We also look at a daily chart of the NYSE Composite, and then we look at the record high percent index. This is continuing to advance. Then we look at the S&P 500 on a monthly chart. We look at that against the PPO, the percentage price oscillator. This is continuing to advance. Longer term, we're still looking positive. Then we compare the S&P 500 to the CRB index, showing how stocks are outperforming commodities. Then we look at the S&P with another global index on a monthly chart. We're well above the moving average and continuing to advance, but the KST is still looking negative. Then at the very end of this video, what I do is I take all the positive things and the negative things, and for me, the definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. We have the biggest software companies that are positive. The euro and the British pound compared to the dollar. Gold and silver are in uptrends. The mega cap stocks. Low volatility stocks. The Dow Jones Composite Average. The FANG Index as well as ARK. And all the different bonds that we look at. Some of those are showing some weakness, but they're still in uptrends. Staples, tech and semiconductors, high leverage loans, the Dow, the mid caps and the small caps, the NASDAQ and NASDAQ 100, even though we've seen some weakness throughout the stock market in the past couple of weeks, the NYSE composite, all stocks, emerging markets, and Bitcoin, all of these are in uptrends. Then we look at what are in downtrends right now. This is when the 50-period moving average is below the 200-period moving average. The growth indexes and ETFs, but we're getting ready to potentially see a golden cross. But we're also looking much more improved with the value indexes. However, for right now, they're both still in downtrends. It's just when we compare growth to value, growth is outperforming. The CRB index, even though it's seen some recent strength, is still in a downtrend. Copper's been chopping all over the place, and it's kind of hard to read that one right now. The dollar index is in an overall downtrend. The Japanese yen to the US dollar, and the micro caps, which I didn't show a chart of that, but they've been seeing some recent weakness. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.